Welcome to the greatest video I've ever made. I have been trading for 6 years and have been full-time for the last 2. And what I've done is taken all of my trading knowledge and put it into this one simple video showing you everything you need to know from beginner to advanced trading concepts. And for this video specifically, I didn't want to make it a ton of fluff or a bunch of nonsense. So this video only covers the really important stuff that actually allowed me to become a full-time trader. I dive in and share with you guys the key concepts and strategies that I use to trade full-time now to make me thousands of dollars every single day. Now, if you're somewhat extra and you want all the information instead of just the important stuff that I put in this video here, I've created a completely free course and community platform for you to join with the link in the description called The Vault. So if you want to learn absolutely everything, go ahead and join that now, 100% free. But for this video specifically, I only wanted to give you the really important stuff so you don't have to sift through a whole bunch of random crap just to get the actual strategies that I use. So this video is broken up into 3 different parts. The first one, I'll go over beginner trading concepts. So if you're a complete beginner, that is what you're going to want to watch through. The next 2 chapters I go over are supply and demand and market structure. And I give you a full blown out course on both of these concepts because those are the 2 main concepts that I use for my strategy to trade today. I go A to Z from beginner to advanced stuff, so no matter where you are in your journey, there's going to be information for you to learn and that you can apply literally the next trading day after watching this video. I legit just use these concepts, and I know it's a long video, so I've put timestamps in the description below, so you can go ahead and skip to whichever section that you want to start with. And all I ask before diving in is that you go ahead and join my free course and community below. Like I said, it's 100% free. We have over 2,000 students in there. It's an awesome community. We hold you accountable. We have live trading and absolutely everything that you need to know when it comes to being a profitable trader. Also, make sure to subscribe because I put a lot of time in these videos, and for 2024, I'm going to go all in on YouTube and make some of the best trading videos that you have ever seen. So you won't want to miss it, but go ahead, get started, and enjoy the video. Alright everyone, what is going on? This is the first video of the video lesson library, and today we are going to be talking about candlestick patterns, okay? Now there's a lot of different candlestick patterns that you can use in your trading, and one thing I want to mention is that these candlestick patterns are not meant to be your sole strategy, okay? They're elements and little things that you can add into your strategy to make them more unique, more specific, more clearly defined, okay? So one thing I just want to go over again is going through this. Once you learn these candlestick patterns, these are only to be added to your strategy. You shouldn't use these as the sole basis of your strategy, okay? So with that being said, let's hop into it. So there's a lot of different candlestick patterns out there. One that I want to focus on is the engulfing pattern. So the engulfing candlestick pattern is very simple. There's an example right here, and it essentially just means the entire body of the green candle takes over the entire body of the red candle, right? So you can see the low of this green candle and the high of this green candle is totally engulfing this candle right here, right? So, and it works both ways. So this would be a bullish engulfing candle, and I can scroll over here. This would be a bearish engulfing candle, right? So you can see how the body from the high to the low here ended up engulfing or covering the entire body of the previous candle before, and it was in the opposite direction, right? So these typically represent reversals, right? There's another one right here almost. So something you could add to your strategy is, let's say price is at a support level, you could wait for an engulfing to form, and then that would be your entry, right? So then the next day, you could get in maybe right at the open or the break of the next candle's high, put a stop right under the low, and then you could target, maybe 2R, 1R, or another resistance zone up here, right? So that's a strategy you could do. If we go back to the bearish engulfing candle, same thing, right? Maybe we take out a high, we're at a resistance zone, and you decide, oh, we get a bearish engulfing candle, that's going to be my entry. So you wait for that to form, you get in at the break of the low, stop goes over the recent high, and then you can target, back down to support, back down to here, whatever it is in your strategy you could target, right? So that's an engulfing candle. That's the first candlestick pattern that I have. The second one is going to be hammers or wicks. Okay, so these ones are very simple. Hammers or wicks are when you see the wick of the candle become very extended and the body is relatively short. So you can see here, we have a long wick at a support zone, so that could be an entry, right? You could get in at a break above the high and put a stop below the low. Right here, we have another wick at a resistance zone, right? So you could say, okay, once we break lower, I'll get in short, put a stop above the high, target down lower. You can see here, another wick, right? Another wick. So this is important because we opened right here, right at 188.79. Price came all the way down here, and then it closed all the way up at 190.44, just about. So that means sellers were active in the day, but buyers were so powerful that they were able to take out all the sellers and close the day green, right? So that's a very, very important skill in identifying candlestick patterns, right? I can even zoom out. There's another one here that I mentioned, right? So this is a doji. Essentially means that the open and close are at the same time period, or same price level, sorry. So you see one of those, you can get in short, stop above the high, target down at the lows, right? You can even zoom out to the weekly. You can see right here we have a nice engulfing pattern again, right? The high and the low engulf the one before, end up gapping down huge, right? So that's another trade entry. Going back to TTD on the weekly time frame, you can see a nice wick here. You can see wick here, here, here. These are all buy entries. And then another doji up here with another nice engulfing right after it, right? So these are all tactics and strategies you can use in your trading. You don't want to do it solely based off that, but it's another thing that you can add to your trading to specify your setups or clearly define them even more. And so right here, I actually have a nice little sheet for you. So if you want, you can screenshot this. These are all the different bearish reversal patterns, bullish reversal patterns, continuations, and neutral candlesticks. So these are things you can add into your strategy, so feel free to screenshot or pause the video and take note of these. But with that being said, this is going to be the first video of candlestick patterns, and I will see you all in the next one. Alright guys, welcome to the next video. This one is going to be on moving averages, specifically a moving average bounce. So when it comes to moving averages, a lot of traders use these, especially fund traders, use them for longer term investing as well. They are used in trading and swing trading, day trading a lot. So we're just going to go over them, how you can incorporate them into your trading strategy. So there are a ton of different moving averages out there. Technically, it's a limited amount you could try. These are some of the ones that I pointed out, which tend to be the most commonly used by traders. So there's a simple moving average and an exponential moving average. The 9 and 10 moving averages tend to be very popular, along with the 20, the 50, and the 200 for the simple moving average. So we can go ahead and look at some charts, get some examples of what I'm talking about. We'll go ahead and look at AMD here on the daily time frame. So right now I have a 9 EMA in blue, and I have a 20 EMA in purple. So EMAs are just lines on the chart, and a very simple strategy you can use is just playing the bounce, right? So you can see here we're in an uptrend, stock's making higher highs, higher lows. It comes back right to the 9 EMA in blue here, and then bounces higher, right? So something you could do is wait for a pullback to the 9 EMA, buy there, maybe put a stop below the 20 EMA, and then target the highs or even higher than that. You can go back, we can even look on the weekly time frame. Zoom out here, right here, perfect bounce right down to the 9 and 20 EMA, and then higher again right here, right here, right here. There's a lot of different examples I can show you. Another thing you can do with moving averages is play the crossover. So if I go on the daily time frame, you can see here, as soon as the 9 crosses the 20 EMA right here, you can get short, so down here, and then ride it down here, maybe short the bounce to the 9 EMA here, and continue lower. You can see here, price crosses the 9 EMA crosses the 20 to the upside, and ends up shooting higher. Right here, crosses it to downside, moves a little bit lower. So the moving average cross is another example that you can trade. One more would be playing a close above. So if I go to NVIDIA, just another example, you can see here, let me find an example. So maybe, let's say you're playing support and resistance. That's your strategy, right? So you have a support line here, and you have a resistance line up here, right? This is your nice little channel. Something in your strategy could be wait for a bounce at support, and then also your second criteria could be a close above the 9 EMA, right? So right here we get the bounce at support, close above the 9 EMA, and explode higher. Or you could wait for a cross. Right here we get that cross, the 9 crosses the 20, moves a lot higher. You could even wait for a push above the 20 EMA. Same thing works. What I can do is actually put on other moving averages as well. So let me put on some of these. Let me get rid of the 9 EMAs. We can put on the 50 EMA, or sorry, moving average, simple moving average, and the 200. You can change that color to black. There we go. So you can see it's the same thing, right? Comes down to the 200, bounces, back down to the 200, bounces, 50, 50, perfect bounce right here off the 50. If you go to AMD, the next thing I want to mention also is these work on all time frames. So right now I'm just looking at the daily. We could go to like a 2-hour time frame or a 1-hour time frame. You know, maybe you're playing the trend, right? We break below the 200, and that's when you get short. We pull back up to the 50 moving average, and then we reject. Maybe we break support, and then that's when you get in your short entry. Maybe as we break above this bull flag here, and you get above this 50 moving average, that's when you get long. You target the 200. So there's a lot of different ways that you can use moving averages in your trading strategy. The key thing to mention is that there is no correct or perfect moving averages. All of them work in their unique ways, and so it's going to be up to you to test a bunch of them and find which ones work for you. Maybe the one that works for you ends up being like the 44, right? There's a lot of different ones you can test out and see which one works. Right here we got a perfect rejection off that 44, right here as well off the 200 and the 44. So a lot of different moving averages you can test. So I would suggest picking ones that you think work for you, test them out on the chart, see what works, and these are just another tool that you can add into your trading strategy. So I hope you guys enjoyed this video, and I will see you in the next one. Alright guys, welcome to this next video. Today we're going to be talking about the head and shoulders trading pattern. This is a very, very frequent and common pattern in the trading world that a lot of traders use in their trading strategies. So we're going to go ahead and break it down for you in this video. So the head and shoulders pattern is very simple. It's a reversal pattern that you'll see a lot throughout all stocks, futures, really any kind of commodity that you can trade. So you can see, let me just draw this here. This is what it looks like. So essentially we have a head, or sorry, we have a shoulder, a head, and then a shoulder, and then a reversal, right? And the reason it's called that is because it looks like, you know, you have two sets of shoulders, and then a head, and then price ends up reversing. So let me bring out the drawing tool. Very simple. Boom, boom, boom. All it consists of is you make a high, a higher high, a low, and then a lower high, and then price ends up reversing. So let's hop into some examples right now. So looking at NASDAQ on the 2-hour chart, you can see we have exactly a perfect head and shoulders right here. So price comes up, right? We make a high, come back lower, make a higher high. This would be the head, come back lower, make a lower high, and then that's essentially where you want to get short. Price consolidates a little more and then ends up going lower. Right, so very, very simple pattern. It just shows that trend is shifting, right? Because instead of making higher lows and higher highs, price now ends up making a higher or a lower high, just like that. And so that helps us identify that a reversal is coming, and that's where we get short for a move lower. Let's look at another example on NQ. This is actually a inverse head and shoulders. So it's the same thing except backwards, and this is a bullish pattern. So price came down, made a low, went higher, made a lower low, went higher again, made a higher low here. This is where you want to get long, and then went way higher. You can see, if I draw that out, very simple, shoulder, and reversal move, right? And assuming you can get short down at this support area on the next shoulder, put a stop below the head, target all the way up, you can get a very nice trade out of that. Let's take a look at Home Depot. Home Depot right here. Same thing on the 2 hour. Price comes down, makes a shoulder, makes a lower low for the head, makes up, breaks this pivot here, makes a lower or a higher low here, sorry, and then ends up breaking out just like that. Very, very simple pattern. You get long down here, right at the support, perfectly in line with the other shoulder, right? Comes right down to that same other shoulder line. You can put your stop under the low here, and then you can target up towards here. So very, very simple trade. This is something that you can use in a bunch of different trading strategies. You don't have to just buy right here. You can add confirmations, add moving averages, add, engulfing candles, whatever you need to do, add to your strategy. Take a look at another example on Square. This one's a really beautiful example. Same thing on the 2 hour time frame. This works on all the time frames, by the way. Price comes up, makes the shoulder, comes down, head, makes the higher low, the lower high here, and then end up reversing. So you can get short here, or what you can do is wait for the breakout, right? So maybe you wait for this trend line break. You see that the head and shoulders pattern is forming. You wait for it to break. You get short here, stop above the highs, and then target all the way down here. Last example here is going to be on Boeing. If we actually zoom out to the much higher time frame, if you look at the weekly, so this is the whole chart of Boeing. The high of the last 4 or 5 years has actually been a head and shoulders pattern, right? Price came up here, went lower, made a head here, lower, made the shoulder, and then end up going down. If I zoom out, bring that out, you have your perfect head and shoulders pattern right here, right? So if we draw the brush, we have shoulders right there and right there, head. Once you see this pattern forming, that's when you want to get short, stop of the high, and the possibilities are endless with this type of trading. So I just wanted to break down this pattern for you guys. This is something that you can use in your trading, combine it with a few other elements, and create your own strategy around this. So I hope you guys enjoyed this video, and hopefully it's something you can use in your trading toolbox. Alright guys, welcome to the next video where today we are going to be talking about support and resistance. So support and resistance has been going on in the markets forever. It's a classic strategy that almost everybody uses. And it's a great thing that you can add to your trading toolbox. So let's just dive right into it. So looking at SPY here, you can see that we had price here in a channel, right? So price came up, down, up, down, up, down, up, down, up, down, and then eventually broke lower down here. So the cool thing to know about support and resistance is that it's pretty easy to spot. You just find where price tends to bottom and top a lot. They tend to do them at the relatively same levels, right? So you can hear on SPY, price hit a high up here at 416, right? Came down to 407, bounced a little bit higher, back down to 407, then all the way back up to a high of 417, and then it went lower. Came back up to this 416 area, dropped all the way down to the 407 area, back to 416 again, and then eventually down to the 407, 408 area, and even lower. So the key thing about support and resistance is that no line is going to be exact, right? So you can see here, the exact bottom of this low here was at 406.96, and the next low was here at 407.67, and then this one was a little bit higher, right? Looking back at the high, we had a high of 416.38, and then we had a high of 417.41, and then 416.60, and then 416.12. So these lines aren't going to be perfect, right? Price isn't going to be exact to the tick of these lines. So sometimes you can even draw these as zones, right? So a zone like there, a zone like here, and then this will act as your support and resistance areas. I'm just going to keep it on levels for now. So this is SPY. A couple different ways to play it. You could just play the bounce to support, right? So you see this is your support zone, price comes down, you buy, put a stop below the lows, and then target resistance. Same thing the other way around. You could go short up here, put a stop above the highs, and then target support, right? So this is another thing that you can add to your toolbox. We can look at another example, TTD. So you can see TTD right here. If we even go out a little more, we can draw the line here. We could even draw another line down here. So this is kind of your support area. Price would come down, rally, back down to the 50s, then up to the 54.65 area. That tends to be a strong resistance. So you could look at shorting 54.65 or getting long at the 50s, right? So if price didn't gap down here, you could be looking for a move back up to 54.65, look to get short, and then target down to the 50s with a stop above the highs just around here. So the cool thing about support and resistance is that you can add the previous learnings in the last video to it, right? So for an example, you could say, oh, I'm going to wait until price hits a support area and then has an engulfing pattern, like right here, engulfs. That's when you get long, right here. Then you can put a stop right below the low and then target the resistance, right? So it's about a 1.38 R trade. Also, support and resistance lines also, they go on forever, right? So you can see right here, this was a good resistance. This was a good support zone. We zoom out to the next few weeks into June, and it acted perfectly, right? Support here, support here, support here, and resistance here, 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 and here. And now we're breaking out. Another example would be Etsy. So you can see right here, very simple, very easy to see. Resistance here, here, here. Tons of touches at this zone where you could get short. Tons of bounces at this level here where you could get long. You can also play the breakout. So instead of just buying the support and selling the resistance, you can trade once price breaks out. So you can see here we have our zones established. Resistance here, price breaks out. Maybe you get long right around here, put a stop just under that support level, target the highs, right? Nice 1 R trade. Same thing here. If I go back to SPY, if you played the short out of this support resistance zone here, as price breaks support, the next support line isn't until all the way down here, right around there. So you could get short here, target down here, put a stop if we get back into this, back above this support zone here. One more example is going to be Amazon. So if I go on the smaller time frame, look at Amazon back here. One thing you'll notice is that previous support levels become resistance and previous resistance levels become support. So you can see here we had a little bit of support and then it broke down, found more support here at 119.36. We came back up. That previous support at 126 ended up being resistance. Found more support at 119 as well, back up to 125.94 and then lower. And then this support zone here, let me draw it as a zone so it's easier to see. Get rid of this. So we actually came back. Once we broke it, that support ended up becoming resistance, right? We came back up to here and then went lower. And you can see if we zoom out, we can use those same zones as well. Here, a little bit of resistance, broke through, then became support right here. And then we started seeing more resistance back in this other zone up here. And then eventually found a little more support here and then eventually broke down. So this is support and resistance, a very classic trading strategy, something you can add to your toolbox. You can combine it with, moving averages. You can combine it with engulfing candlesticks. You can combine it with wedges, a bunch of patterns, other things that you're going to learn in the next few videos. So I hope you guys enjoy this one, and I'll see you in the next one. Alright guys, this video is going to be on Fibonacci retracements. So Fibonacci retracements are a really cool tool that you can use in your trading. I use it sometimes. I know a lot of people like to use it. There's a lot of different ways to use it. So we can go ahead and just dive in and show you exactly how to use the tool. Now, it works differently on other brokers, but for this platform on TradingView, if you click right here, You see a bunch of different tools pop up. The Fibonacci retracement is right here. There's a couple different other ones, trend-based fib, fib channel, fib speed resistance fan, a lot of these. Again, the most basic, the one that a lot of people use, is just the Fibonacci retracement. Once you click on it, you're going to have to go from a low to a high. So it's very critical that you use nice pivot points where price was at a low and the price was at a high. So let me just draw it out for you right here. What it does is it plots out different support and resistance levels. So you can see here, I drew the low here, the high here, and you have these bunch of levels in between. So you have a 0.786, 0.618, 0.5, 0.382, 0.236. So these are the most common Fibonacci levels. These are standard. It's what a lot of people use. And basically what they do is they act as support and resistance levels. So let me show you some examples here. If we're looking at Microsoft on the daily chart. If we take our Fibonacci retracement tool, go from the swing low here, all the way up to the swing high here, you can see that we ended up bouncing right at the 0.618 retracement level. So the 0.5 and the 0.618 are very, very common. The 0.618 is known as the golden ratio. It's where you'll find a lot of pullbacks, and it happens very well in all markets and all time frames. It happens all the time. So you can see, after we made that move up, we drew our Fibonacci, pulled back right to the 0.618, kind of consolidated, and then made another move higher. What I can do is I can actually keep drawing them. So now a new high gets formed. We see prices pulling back. Where am I going to draw my levels? Take it from the swing low all the way to the swing high, and right there, beautiful bounce right off the 0.618. Again, these Fibonacci levels are not always perfect, but they do tend to work pretty well. And you can see we acted as resistance at the 0.236. We bounced back off the 0.5. So a lot of different ways to play these. So I'm going to show you a few more examples of exactly how they work. We can go ahead and actually go all the way up to the next swing high, this low, all the way up to this high here, and get a beautiful bounce right off the 0.382 mark right there, 0.382. It's a beautiful bounce play. We actually had a nice bounce off of 0.236 as well. Again, just another way to play the Fibonacci. Let's go ahead and take a look at another example. So gold, you can see price comes up, makes a high, has a pullback. You might be wondering, where is price going to pull back to? If we draw our Fibonacci, right there, we dipped right above the 0.5, in between this 0.5 to 0.618 zone, ended up tapping it, and then ended up going lower. Let me draw some more, see what we can get going here. Take that high down to the next swing low that was formed, right there. Ended up tapping the 0.382 exactly to the tick before dropping lower. So Fibonacci is a really, really cool tool you can use in your trading. Again, if you want to know which level works, how do I know where the bounce and where the bounce is going to come from, which level is it going to be? There honestly is no answer to that. It's just another thing that you can add to your toolbox, right? So maybe you have a strategy where you're doing trend. So you make, low, high, lower, low, and you're expecting a higher high. You may add in your strategy that you want price to go more than 50% before you end up looking to short. You may say, oh, I only want to be shorting at the 0.382 mark because that's very common with something like gold. It's just another way that you can use this in your trading. Let's take a look at another example on Citigroup here. Nice low forms right there. Bring it up to the high. We get a beautiful bounce right at the 0.618, back to the 0.236, and then back down. Really cool examples. One more with Twitter. Get rid of this zone here from the low all the way up to the high. Beautiful bounce at 0.5, ended up dropping right below it, and then back up to the 0.236. So these levels aren't perfect. There's a lot of different ways to use it. It's not something that's going to totally change your trading. That's not something that you can use 100% as the sole basis of your strategy, but it is something that you can use for confluence, for conviction. It's another piece of strategy that you can add to it, something that you can add and make sure that you have more conviction when you are trading. So hope you guys enjoyed this video. Maybe you can add it to your toolbox, maybe not. It's worth checking out. And yeah, that's the Fibonacci retracement tool. Alright guys, welcome to this next video going on trend lines, wedges, and patterns. So this is a pretty simple video. The whole idea is just that stocks tend to make very simple patterns, and one of them is a wedge. A wedge is simply when price just gets very, very tight and then ends up breaking out. So if I get a arrow in here, basically you'll have price come here, get very tight in a wedge, and then move higher or lower, depending on the position that the stock is in. So here's an example on ES. It's essentially just when price is making higher lows and then lower highs, right? So you kind of get this wedge formation where price just keeps bouncing back and forth, and then eventually it's going to break one way, right? So in this example, it breaks lower. So you can see all you have to do is just draw your trend lines, take the high, find the lower high and draw it from there, and then extend it out. And then same on the bottom, take the lower, or sorry, take the low, take the higher low, and then extend it out like that. So this is an example on ES. Let me show you an example on NQ right over here. Because you can see price makes a high here and then a low here. It makes a lower high, and that's where you draw your trend line out. And then it makes a higher low, and that's where you draw your trend line out. And so you can see price came up and tested this trend line one more time. Price got more consolidative as time went on, and then eventually broke out. And that's when you want to take the trade, is once price breaks out of this trend line, out of this wedge, that's when you want to take the trade in that direction. You can see price exploded and never looked back. So let me look at an example on PLTR. There's a few different ones here. This is one that's literally happening now as I'm making this video. You can see price. So this is a rising wedge. Price came higher, lower, higher, lower. And you can see if you just draw with your trend lines, we're making a wedge here as price is getting tighter and tighter as time moves on. And eventually price broke out, and that's when you would expect to get short or price to move a lot lower. If we zoom out, we can see another one right here. This is the classic wedge where we get tighter and tighter, and then eventually price breaks out. That's where you can get long for the move all the way up to 14s. One more here on PLTR. This one's a little bit easier to read. You can see here we have a high, a low, higher low, lower high, higher low, and we just keep going and going and going, just like this. And then we get our wedge, and eventually it breaks down and continues a lot lower. Let's take a look on W. This one's a little bit bigger. You can see we have this wedge pattern. Price gets tighter and tighter, and then eventually it breaks, and then that's when you want to take the trade. So this is just a quick video on wedges. There's no wrong way to draw them. You can draw them pretty much anywhere, right? So I can look right here, draw one like this, and then even one like this. You can see how it follows the trend line pretty well, and then eventually breaks lower. New ones form, and then that's how price moves on. So I hope you guys enjoyed this video. It was pretty quick, but just a quick overview on something that you can add to your trading toolbox. So you could combine this with supply and demand. You could combine this with support and resistance. You could combine it with candlestick patterns. There's a lot that you could combine this with to form your own trading strategy. So I hope you guys enjoyed this one, and I will see you in the next one. Alright guys, this video is going to be on RSI divergences. So RSI is an indicator that is widely used by a lot of people, but a lot of people don't use it for the divergence, which is a really cool strategy that you can add to your overall trading system. So let's go ahead and get right into it. So this is the RSI down here. When it's above 70, it's typically over strong, and when it's below 30, it's typically pretty weak. Meaning that price may reverse when it gets below 30 and price may reverse when it gets above 70. The divergence is when RSI is showing something different than price. So let me explain that to you right here. Let's take a look at BABA on the daily chart. So you can see that on BABA, let me zoom this in as well. On BABA here you can see price made a high at 121, we went lower, we made a higher high at 125, and then ended up dropping a lot lower. The thing about RSI, which is relative strength, what happened is we hit a high of about 71, and we made the higher high on BABA. We actually made a low at 64. A higher low at 64. So this is the divergence that you can see You can see on the stock of BABA, the line is going up and to the right, and on the RSI, it's going down and to the right. So that means that although BABA was able to make a higher high, the relative strength wasn't. So price is showing something different than what the real strength of the stock is doing. And that's the key of a divergence, showing something that it really isn't. You can see there's another example right here as well. BABA, we made a low, went to a high, made a lower low at 78, and then ended up going higher. If you look at the RSI divergence, you can probably spot it out yourself. Right here, the low is at 30, and then we made a lower low, and we actually ended up making a higher low on RSI. You can see price ended up reversing for it, right? RSI shows the real strength of a stock. The price is just a distraction from the real strength. So you can see here, this is a really cool divergence you can see on BABA. It's two examples right here. I'll show you one more on X. You can see here, price ended up making a higher high. You can see if we bring from this high here all the way down, and then we draw it out to where the higher high was met, we ended up making a higher low on the RSI. So it's a really cool divergence. You can see after that, price got a reaction, made one more push higher, and then ended up dropping after that. Now this strategy works on all time frames. So we can go ahead and look at gold futures on the hourly chart. You can see the RSI here. Price ends up making a lower low. So we have lower low, but on the RSI, we have a higher low, right? So typically you want to see lower low. You want to see them go with each other, right? So when you see a lower low on the stock, you want to see a lower low on the RSI. When you see a higher low on the RSI, it means that something is off and that price may be reversing. Okay, it's not 100% just like everything else out there, but it is something that you can add to your trading toolbox. You can add it to a trend trading strategy. You can add it to a reversal strategy. There's a lot of different ways to use it, but I just wanted to come on here and show you guys the RSI divergence, and maybe it's something that you can add to your trading system. Alright guys, this video is going to be on volume profile. Volume profile is a really cool tool that I use in my trading a lot. And it's something that you can add to your trading for another confirmation or whatever it is. It's a really cool tool that you can use and add into your strategy. So let's just get right into it. We're going to look at NQ NASDAQ futures. So on TradingView, volume profile, you do need the paid plan. However, on Thinkorswim, which is TD Ameritrade's platform, it is free. But on TradingView, you go to indicators, technicals, and it gives you a bunch of volume profile ones here after you click volume profile right here. I personally love doing the visible range. That one just goes off whatever range your chart is looking at. So we're going to let this load in. This is what it looks like. All it's doing is showing the volume in a horizontal time axis, right? So here is where you're going to have high volume at these points. There's a lot of volume at these prices. And down here is going to be lower volume, right here, here, here. This is where there's all going to be lower volume prices. So if I go in like a 2-hour chart and I look at NASDAQ, let's go like right here. What it's going to do once it loads is it's going to bring up all the volume, and you'll be able to see something called high volume nodes and low volume nodes. So high volume nodes are going to be areas where there's a lot of volume, right? So you see this little chunk here, a lot of volume. There's a decent amount of volume right here as well, here as well. There's a lot of different volume you can do. The way I look at volume profile and the way a lot of people use it is they draw zones in the low volume node. Right, so if we see this little low volume patch right here, if I just draw my box out and zoom out, that's going to be a low volume node, right? Another one would be right here. Just draw this box out just like that. That's a low volume node. Another one right here. This little box, draw that out. The reason these work is because they're very good for reversals, right? So we can just get rid of this right now. If I just look at the zones I drew, overall, they're not bad for support and resistance, right? Came here, it was support, and then a little bit of resistance, support, resistance here. You look at this line, this box, really good support line here and here. Support, and then once we eventually got below it, acted as resistance right here. Then this box, support, got below it, resistance, support, resistance, back above it. And this box was resistance again. So you guys kind of get the idea of how these low volume nodes work. So let me go over to Spotify and give you guys another example. This also works on all time frames. Let me bring this up again. If I look at the weekly chart on Spotify, you can see right here, this was the lowest amount of volume in this whole area, right about here. And if I zoom that out across, you can see how perfectly it worked, right? Resistance, resistance, once we got above it, support right here, then we got below it, act as resistance again, right? I can even go down on the daily time frame, right? Right here. Lowest volume is going to be in this zone here. I zoom that out, nice support, nice resistance. So if price were to get back above this, right, we could probably see a bounce back in this area. It may not go all the way up to, the 180s, but the likelihood that we see a bounce is high, right? So another thing that we can do is even zoom in more on like the 2-hour chart. We go here, look at something like this. Right, so now we're even more zoomed in. We can go ahead and look at these mini zones, right? So right here, perfect. Look, support here, then act as resistance. Once we got back above it, more support. And then we look right here, this zone as well. Didn't work so much back here, but it's a nice support bounce right here. Once we got above it, support here, and then resistance here. So obviously it's not going to work 100% of the time, but it's a really, really cool tool that you can see where there's low volume and where there's high volume, because typically a lot of reversals will happen at low volume prices. So this is another cool tool that you can use to your strategy. You can incorporate it in, add it with some confirmations. And it's something that you can definitely build a profitable trading strategy based off of. So hope you guys enjoyed this video, and maybe it's something that you can use in your trading. Alright guys, this video is going to be on relative strength. Relative strength is a very, very cool tool that a lot of traders don't really know about, but I use it a lot in my trading, and it's a great thing that you can add to your trading toolbox. So let's go ahead and just dive right into it. So relative strength is all about stocks that are strong relative to the market, right? So when the market is going down, like SPY or the Qs are going down, you want to see which stocks are going up, okay? Because that means that institutions or banks are holding the stock up, and they're stopping it, or they're not letting it go lower because they're buying all the shares. So let me give you a quick example in a quick video and break this down for you. So let's take a look at SPY. You can see back in 2021, we had this massive bull run, and there was a few dips throughout the year. And if we look at this one specifically, I'm talking about from June 15th to June 18th, right? So 6/15 to 6/18, you can see that there's a pretty decent drop. If I pull out my price range here, from the high to the low, the market dropped about 2.5%, which for SPY is a pretty big drop, okay? So remember those dates, 6/15, 6/18. Now if I go to Microsoft, I have the same dates shaded out here, right? 6/15 to 6/18, these 3 days. While the market was dropping, Microsoft actually went higher, okay? Yes, we had a down day here and here, but on the 17th and the 18th, we actually moved higher. And during that same time, SPY moved lower, right, at a huge gap down. If we go back and look, huge gap down on the 18th. Then Microsoft, we actually just moved, we didn't really move much. We gapped down slightly, but we stayed overall the same, okay? That's very, very important, okay? That shows that Microsoft is very, very strong. And ever since that move, it's gone straight up. It has never even looked back, okay? And you can see even then, it even went way higher after that, okay? So that's just one example. Let's take a look at Roku. Same dates, right? 6/15 to 6/18. If you remember, on the 18th, we had a huge gap down, okay? Roku had a small gap down, and ended up the day way up, okay? Ended up the day, up 6%, right? When the market gap down, 1.5%, right? So why is Roku up when the market's going down? There's an imbalance there, okay? It means Roku is very, very strong compared to the market. And you can see this had a massive, massive move the next week or so, okay? And then we came out, took out all-time highs, and then eventually went lower, right? Let's take a look at Meta. Same days, okay? So Meta actually did move a little bit lower, right? If we go from the 15th down to the 18th, we moved down about 2.5%, okay? But relative to SPY, that's not a big move at all, right? Right? Something like this on Meta would be a decent move lower, right here, like 9%. Meta barely even moved lower, right? We're still held within this entire range right here, right? We never made any substantial move lower. We never made a lower low, right? Never broke this low down here, anything like that. And ever since then, Meta rallied and has been going up until, the eventual bear market that we're in right now with SPY, right? So these are opportunities that you can use in your trading. Hey, I used a daily example. This works on the 5-minute or the 15-minute, right? Even on the 5-minute, right? This move from like 950 to 1045. If you can find another stock that's going up throughout this, I can't find one off the top of my head right now, but I'm sure there are stocks that are out there that are moving up. These are things you can look for and use to your advantage in trading because they have relative strength to them. So this is something that I just wanted to let you guys know about. It's something you can add to your toolbox. I use it a lot, especially for swing trading and for longer term holds. So use that to your advantage and test it out. See if it works for you. Combine it with a few other elements to get your strategy going. And yeah, I hope you all enjoyed this video and hopefully you can get some value out of it. What is up, guys? Hope you all are doing well. First off, I just want to say thank you so much for taking the time to invest into my course. I think you guys are going to learn a lot from it and love it, and I put a lot of effort into it, so I think you guys are going to find it very valuable. So first thing I want to say is hopefully you guys can watch the entire course in its entirety. Don't skip any videos, watch them in order, watch them to its entirety. It's going to be very helpful because a lot of the videos tie together with each other. So without further ado, let's just go ahead and hop into the first video of what even is supply and demand and the types of supply and demand zones. So what are supply and demand zones? So supply and demand zones are areas of institutional price action. So that means these are areas where institutions, big banks, there's a lot of big money are trading, right? And banks, they're not right 100% of the time, but most of the time they are. And so they leave ways that you can follow their trades, and that's exactly what supply and demand is. So how to identify where supply and demand zones are. Now, the first thing, before I get into the speed and balance versus imbalance, first thing I want to notice is what markets are actually like and how they actually work. So a lot of them are built off of balance versus imbalance, right? So all these gray zones, this right here is an example of what a stock could look like, right? You have gray zones and then you have these black lines, right? So the black lines everywhere is price, right? This is all price. The gray zones are areas of consolidations, right? So when price is trading in a tight range, not a lot of movement, and then that would be called balance, right? That's balance. And then you have areas where price is inefficient. It's called an imbalance, where price goes really fast, doesn't spend a lot of time, doesn't consolidate, and those would be these in between the gray zones here, right? So you have balance, then it moves up, then you have more balance, imbalance, down, higher, lower. You got the idea. So how do you identify where supply and demand zones are? Well, it's about two things, right? One of them is knowing your balance versus imbalance. So knowing what a stock looks like, what a stock chart moves. The second thing is going to be speed, okay? And that I capitalized it because it's very, very important, right? Supply and demand zones are only caused by speed, right? So you can see here we have very fast price action, consolidation, very fast price action down, more consolidation, very fast price action up, right? So if you ever see price action that's, maybe we consolidate here like this, and then it just kind of goes really slowly, kind of choppy, down like this, I would not consider this a supply zone. And we'll get into more examples in the future videos, but right now, just a basic idea, two things, speed and balance versus imbalance, okay? So let's dive into the types of zones we have. So there's 4 different zones, right? We're gonna just stick with demand for now, and then I'll get into supply in a second. So we have something called a drop-based rally and a rally-based rally. So going back to what we said with the balance versus imbalance, price drops, consolidates, and we have a fast price action move higher, right? That would be the rally. So drop, this is the base, and then rally, right? Pretty simple concept. Then the other type of demand zone is a rally-based rally. So price rallies, it consolidates, we have another fast price action move higher, that's another rally, right? So it's called a rally, base, rally. Very, very simple stuff, right? There's only 2 types of demand zones, and those are it. Supply zones are basically the same exact thing, except the opposite, right? So we have a rally-based drop, so price rallies, it bases, and then it drops. And then we have a drop-based drop. So price will drop, will base right here, and then drop even more. So we have these little areas of consolidation, and we have areas of big price, very fast price movement, okay? So these are going to be your supply and demand types of zones. Now, I don't really call them out, DBR, RBR, RBD, DBD. I don't say that a lot. It's just the types of names to identify the zones. So that's something you can use in your trading if you do so. I don't really talk about it that much, but these are the type of zones and the names that they have. So what do the zones even look like? They're just the areas of consolidation, right? So if we go here, we have a drop, we have a base, and we have a rally, right? And so the thing I want to mention is your demand and supply zones. I'm going to be more specific and go actual, scenarios and look at actual stocks in the next video. But for these purposes, the price where the consolidation is, that's going to be where your demand and supply zones are. So these balance areas, these are going to be where your zones are, right? And you can just extend the chart out. So we look down here, price drops, we base, and we rally higher. We have that fast price action. What are we expecting? If we draw this demand zone out, right? So this was the consolidation. All I did was took a zone and I drew it out. What we would be expecting is price to come back into that demand zone and then a bounce, right? Because what happened is price comes down, a bunch of institutions load up shares, they bring the stock higher, they sell. And when price comes back down, there's unfilled shares that the institution needs to get filled. So what happens is price bounces out of that zone. And it's a very, very consistent pattern that you can use in your trading. And it's basically what I trade my entire strategy on, is supply and demand zones. It's a very repeatable process, right? So looking back, this would be a rally-based rally, right? So we rally, price bases, price makes another rally. What I would be expecting is when price comes back into this demand zone, I would expect price to make a higher move out of it, right? It may just bounce here, or might even go all the way up here, right? That's more for in the future videos as well. Going back here, we have a rally, base, drop. So again, price rallies, bases, and then drops. And then we would expect to move back to that supply zone, this consolidation. We'd expect more shorts to get in and price to move lower. And then same thing, price drops, bases, and then drops again. Price creeps up, hits that little supply zone, that consolidation area we had, and then ends up moving lower. So all in all, that's supply and demand. I gave you the 4 types of zones, how they work. You'd expect price to bounce off of them, institutions. Again, main things to consider are speed, right? So you need to be looking at how fast price is and looking at fast price action. And then balance versus imbalance, understanding how the market moves and what kind of market structure is created in all of these stocks and futures. So with that being said, that is the end of this video. Hopefully you guys took some notes and learned something, and I will see you all in the next video. Alright guys, welcome to the next video. This one is going to be on drawing supply and demand zones on actual charts, kind of how to draw them, what they look like, etc. So let's go ahead and dive right into this one. So the first thing I want to mention is that drawing zones on the charts, they work on all time frames, right? So whether it's a monthly, weekly, daily, hourly, even up to the 1 minute, it will work on all time frames, right? And looking at which time frame you want to look at depends on a number of factors. That's something that can be discussed in a future video. So let's go ahead and get started. There's really 3 steps when it comes to drawing zones on the charts. First one is going to be, identifying the base of the explosive move, so where the actual consolidation is, where the supply and demand zone is. You're going to draw a zone from the base, and then you can use the wick or the body, and I'll get right into that in a second. So right here, you can see we have a drop, base, rally, right? So let's just assume this is very fast price action here. We have, drop, we have a small 2-candle base, a little consolidation here, and then a huge move higher, right? So where you want to draw is identify the base right before the explosive move, right? So this is the explosive move, right? This candle here. So we're going to go to the candle right before it, which is this green candle here, okay? And we're just going to draw a zone, right? So we're going to take that candle from the high of the wick down to the low of the wick. Let me make that gray. And that's going to be our demand zone. We extend that, and then as price goes back into it, we would expect to bounce out of that zone, okay? A big misconception that people think is that, if we have a demand zone, a big green zone, it has to be a red candle. You have to draw your zone based off the red candle. That's just simply not true. It doesn't matter what candle it is. You just want to identify where the real base is, and you want to draw your zone right before the huge move, okay? Because that's where all the unfilled orders are going to be. Now you see in number 3, I say can use wick or body, right? What do I mean by that? So in the last candle, I went from the high of the wick to the low of the wick. Sometimes what you can do is use the body. It depends on a number of factors. So I'll use them interchangeably. It kind of just comes down to personal preference and what works better for you. But the body would just be the top of the body. You still want to go down to the bottom of the wick, right? So one thing that's important to keep in mind for demand zones, you want to always go down to the bottom of the wick, okay? You don't necessarily have to be the top of the wick, but the bottom of the wick. Vice versa for supply zones, you always want to go to the top of the wick, okay? You want to encapsulate the entire bottom of that move, right? If that makes sense. So that's how I draw my zone. So you just take it from the top of the body, and then you could use your zone just like that. Price comes down, expect to bounce out of it, right? Supply zone, right? So this would be a drop, base, drop. So these consolidation or zones can happen in a matter of one candle, right? So a lot of times, if you can see, price comes down, it can have a 1 candle consolidation and then continue dropping, right? As long as we see that fast price action, move this down here, you see a nice explosive move lower, you can draw your supply zone right from this candle, right? So we go from the low to the high of that candle. This is the candle right before the explosive move, and extend it out. And then as price comes back up, we would look to short in this area, targeting move lower, right? And again, if you want, you could also go from the body. So that would be right there, the body, and then you have a little bit of a smaller zone for a better risk reward. So that's basically how it goes, how you draw them. We're going to look at some real examples right now. The first one actually being on Zoom. So right now I have the weekly chart pulled up. So you can see here, I can even look at the monthly if I wanted to. Actually, yeah, why don't we look at the monthly? So monthly we have huge move, right? So we have a huge rally. We have a 1 candle base. And we have a huge move higher, right? We have another rally right after it. So this little consolidation, this monthly candle, which on the weekly, has this big consolidation area right here. You can see price makes that rally. It bases, consolidates. And we have that huge move higher, right? That's your rally-based rally zone. So if we go on the monthly, we go from the top of the body or top of the candle before it down all the way to the bottom. And if the bottom of the explosive move candle ends up going lower than the candle before it, in this example here, you want to go always down to the bottom, right? So you want to find that explosive move, and you always want to start from the bottom of that explosive move, okay? So go back to the monthly. It would just be like that, and then we draw that zone out. And you can see price came back in, tapped the top of the zone, and then ended up going all the way back up to 405. If we look at the weekly, it's a little bit easier to see. You know, we have this big kind of zone here, ended up going higher, came back down, tested it, and then had a nice bounce, right? So there's a few things to mention here, right? First one, you can see price actually had a mini rally-based rally zone inside this zone, right? So price has a rally, we have this one candle consolidation here, and then another rally higher. So we could even draw a weekly zone right here from the top to the bottom. And you can see price ended up breaking it below here, but before it, price tapped the top of that zone right here and then ended up bouncing up to 344, right? So it's still a nice bounce from that zone. You can see another supply zone here, looking at the weekly. Let me just extend that out. You see price drops. We have that one candle base, drops even more, fast price action. We came back, tested it, and then went all the way lower, right? You could easily see another one right here. If we draw this zone just like that, price comes down. We have that one candle base, huge fast move down. Remember, speed is everything. Fast move down. This would be our supply zone. So if price wanted to and we saw it came back up, I would be interested in shorting in this zone for a move lower. So that's zoom. Let's take a look at TTD. Beautiful move here on TTD. You can see price again. There's actually another zone here that I just saw off the top of my head. Right down here. So I draw this out just like that. Price has this consolidation period. We have the little consolidation here, and then we have that fast move higher. You look at the candle right before the fast move, draw your zone, and we get a nice bounce there. Same thing right here. If I go to my path, we go up, we rally, we have a little base, we rally even higher. This one I took from the top of the body down to the lows. Price came back in, bounced all the way up to $80, right? From low of 57, right? So overall, you can get some very good moves. Again, supply, rally-based drop. Price rallied. We have that one candle base, that fast price action, fast move drop. We come here, we tap it just to the tip, and then end up dumping. So that would be TTD. CRM, right here. Right, so ignore this for a second. If you look here, right here, say we have very slow action, prices kind of grinding up, pullbacks, up, very slow grind, and we have this huge fast move, right? If I pull that up, this is what that looks like. We have the slow grind and the fast move. So if you remember, we want to look at the fast move. That's where the supply and demand and institutional activity is. So we take the candle right before that big move, which would be right here, extend it out. You can see price came to it, bounced, ended up going all the way higher up to 310. Again, even intra week, right? Price moves higher. We have that base, topping candle, and then a fast move down, right? That caused supply. Price came up to supply. And it didn't have a big move, right? We look at supply here, we kind of tapped it and then moved a little bit lower back into this demand, ended up moving higher. And looking back at the weekly, so let me get rid of some of these zones. We have another demand zone, right? Price bounces off demand. I could draw it from the base right here. We have this explosive move higher, with the move starts here, comes back, bounces, very clean move off of that. Take a look at Etsy. I think I only drew one example down here. Looks like it's on the daily. Yep. So we have the one example here. Price, drops, has a base, has earnings, makes a huge move higher, comes back down, and then bounces out of that zone. So I just took it from the top of the body, came back down, very nice move. Take a look at Boeing. Few examples here. One thing that I wanted to mention as well is gaps. Anytime you see a gap with stocks, that also is going to work as very good zones, because gaps are the fastest price action, right? It technically happens overnight, and it's very, very fast price action. So you can see we gap down, we have a strong move down all the way down to 190, right? From 230 to 190 in a matter of, maybe 2 weeks. Price comes back up, tests that daily demand zone, right? This is the candle right before the huge drop. Comes back down, tests it, end up going way lower. Right here, price comes up, comes back down. We have that one candle base, huge fast move lower, right? So if you look again, such a fast move because of nice efficiency. This is where the move started. So you took it from the base, from the low of this candle to the high, end up tapping it and then moving all the way lower. We end up forming another supply zone out of that reaction, right? So we come down slow price action, and then here fast price action, right? So this move starts right here. We can take it from the body, taps it right to the tick. We could also take it from here. If we look at the low, right from there, the low of that candle, which is the candle before the move, and it ends up going lower again. So hopefully this cleared thing up for you guys and it makes a little more sense. Again, gaps also work, so you can look at very fast price action, and that will work as well. Overall, these are the kind of the rules I use, the basic guidelines I use. So hopefully you guys enjoyed and learned from this video, and I will see you all in the next one. Alright guys, what is going on? Welcome to this next video. This one is going to be on entries and stops for trading supply and demand. So when trading supply and demand, there's a very, very simple and easy way to tell where you should enter and where you should exit. So we're going to look at an example on Etsy right now. So you see we have this demand zone here at 123. So it goes from 123 down to 109, right? So very simple. The way that I trade supply and demand and how most people do it is you want to get in right as soon as it touches demand. It's very common for sometimes supply and demand to kind of just touch the top of the zone and then end up reversing. So instead of kind of just guessing where in the zone to buy, I always enter, most of the time I would always enter at the top of the zone for demand. It would be at the bottom of the zone for supply. And I'll show you an example later in the video. But for now, I'd want to be getting in right at this 122 or 123 level, right? So let's say price comes down and it's demand, get in right here on the 11th. And where do we put our stop? Well, it's pretty simple. You just want to put your stop right below that demand zone, right? Because if price breaks demand, it breaks that low, it shows that sellers are stronger than buyers and that this zone is now invalid. So I don't want to be inside the trade anymore. So that's the one thing I love about supply and demand, is that it's very clear on where to enter and where to exit for your stop loss. In terms of your target, that can be determined on a number of different things. It can be based off your strategy. It could be based off candles. It could be based off whatever you want, right? It's no real answer to, or correct answer of where your target should be. So a very common thing that you can do is target the next supply zone, right? So if we're looking at this example, we have a mini supply zone right here, this candle, just like that. That obviously ended up breaking, but you can see that price came down, and then we could put a target right here. So if we were to take this trade, I'd be getting in along there, stop right about there, target would be that supply. So about a 1.19 R trade, not bad at all. Now obviously this supply zone broke. Not every supply and demand zone is going to work 100% of the time. That's just how trading is. There are a number of ways to tell, when zones are not going to work. I'm not going to show you that in the next few videos, but for now, for entries and exits, you just want to be getting in right as price enters, and getting out if it gets below that demand zone. So taking a look at Costco, you can see we have a really nice demand set up here. So price came down, we have a drop, we have a base, and we rally, right? Very strong price action, nice demand zone here. So if price came down, I would be expecting a move into this zone and then a push out. So a very simple trade I could put on. It's getting in right at that 515, 516 area, putting the stop right below it. And then I could target possibly at the highs. That's about a 4.2 R trade. Very, very nice risk reward. Let's take one more example at Zoom. On the weekly chart, go up here. So you can see Zoom on this weekly supply, we dropped, we based, we had another drop, DBD setup. So on the weekly time frame, Zoom came up, tapped it, and then went all the way lower. So we could have got short with puts right at this level here. Stop would go right above that supply zone, right there. If we wanted to, we could target maybe the lows down here for a solid 2.3 R trade, right? So that's how you find entries and stop losses. One other thing that you could do, if sometimes these demand zones get pretty big, so like maybe, we'll just say a zone was this big, and, you don't want to be risking, like 43 points, right? You don't want to be risking that much. Something you could do is wait for the reaction and then move your stop above where the demand or supply zone hit. So in this example, right, this is our zone. Instead of getting in at 290 with a short and putting the stop above 307, what you could do is wait for the reaction, right? So maybe after I see that the supply rejection works and now price is down here at the 270, I could get in short at 270 and then I could just risk the top of this candle here of where it got in, right? So you're lowering your risk a little bit if the zone is pretty big. So that's something you could do as well. So I hope you guys enjoyed this video. Again, it's very simple of where to put your entry and your stop, especially when using supply and demand. And so I will see you all in the next video. All right, guys, what's going on? So this video, we're going to talk about high quality versus low quality zones, okay? This is a very important concept that you need to learn when it comes to trading supply and demand, because you don't want to be forcing setups that are on very low quality zones, right? It's very important that you're only taking A+ setups, very good setups. So today I'm going to show you how to do high quality setups with supply and demand. Now, when it comes to finding high versus low quality setups, it really just comes down to one thing and really one thing only, and that is speed, right? Speed is the most important thing, okay? The faster the move, the higher quality, okay? I'm gonna write that down. Faster the move, higher the quality zone, okay? So this is very, very key when it comes to supply and demand. So let me show you a quick example on NQ futures, NASDAQ futures. So you can see right here, we have a very, very nice supply zone. This is an A+ supply zone here, okay? You see price chops around here. This could also be considered a much bigger zone here because of this move, but price comes down, right? We have a small consolidation. We have a huge fast move down, right? So you can see this was such a fast move. It went from 12,300 all the way down to 11,200 in a matter of a few days, right? This was a weekend, but you get the point. It's a very fast move. Came down very, very fast, right? So this would be an example of a very good zone, right around there. And you can see we tapped it and then immediately went lower, right? So the thing I want you guys to understand is just being able to tell the difference between this kind of zone and, this type of price action here, or this kind of zone, right? All of this price action, you have a bunch of wicks, very back and forth, a lot of whiplash. There's not going to be any good zones in this area, right? There's not going to be any good zones in this area. You can just see, there's a lot of wicks here, not a lot of fast price action. We don't see any really good zones until we start getting into this, right? We get the fast moves, right here we get the very fast moves. This would be a really good zone. This would be a zone, not the greatest, right? It's still a little choppy, but we get a decent move. So it really just comes down to speed, right? And looking at zones, the thing you guys need to understand is just the difference in price action, right? So look at this price action right here, right? In this oval. See how it's very slow, very choppy, very back and forth, a lot of wicks. It's much different than this, action right here, right? you can see that they had the same or similar amount of price, right? So this was down about 810 points, and this move was down, close to 800 points, right? Almost the same move. This one was a lot faster. This one happened in, just a few candles. This one, it took a lot longer, a lot more candles, right? So this price action here, there's not going to be any good supply zones, right? Yeah, you could probably fish one out, like maybe right here. But again, these are low quality zones. This is a low quality area, right? The high quality zones come from the fast price action, right? So all the way up here at this top, right? We rally, we base, we have a huge drop. We end up going slower after that. So this would be an area that I would be looking to short on NASDAQ, right? Let's take a look at AMD. Oops. So AMD, if I go on the daily, here we go. AMD on the daily, you can see right here, we have a supply zone, right? Price rallies, we base, and we drop. And we have another base, and we drop more. This is just not that fast price action, right? You can see, yes, we have the supply zone that ended up breaking right here, so we would have got stopped out. But look into this, you can see, right, we had that rally, we had the base, we had the drop, but then we just have more consolidation, right? We have another base, then we drop, and then 3 more candles, still got some wicks. We got not the biggest body of candles, right? They're relatively short, right? We're not seeing any kind of moves like, this fast move. We're not seeing anything like, this type of candle here, which went up, 11% in one day. We're not seeing any of that in this action, right? And so clearly, if we took this zone here, right, this drop, base, drop zone, it did end up work, right? We tapped it at 115, pulled back a little bit, kind of consolidated. But, it's a low quality zone. You're not going to get the best trade results doing that type of zone, right? So you want to make sure that you're doing high quality zones. And the best way to do that is by looking at ones with the most speed. So again, going back to NQ, speed, faster the move, higher the quality zone. So you only want to stick with high quality zone, fast price action, and that's how you're going to get the best results with supply and demand. So hope you guys enjoyed this video, and I will see you in the next one. All right, guys, what's going on? Hope you guys are having a good day. So in this video, we're going to talk about market structure and why zones fail. As you may recall, I said supply and demand zones do not work 100% of the time, just like any other strategy. So today, we're going to talk about a concept that can help you take more higher quality setups and ways to tell in which certain setups will work and certain setups won't. So let's just dive right into it. So one piece of important information that I want you guys to know is that you should only be buying demand zones that have taken out supply and only selling supply zones that have taken out demand. So what does that mean? So I'm going to show you a few examples right here. So let's take a look at Zoom. So you can see obviously Zoom, is in a downtrend, right? Lower lows, lower highs, lower lows, lower highs. And we see that this demand zone forms right about here, right? Price drops, we base, we have a pretty strong rally, right? Nice demand zone forms. And what happens? Price ends up coming down. We end up getting a small reaction, right? So maybe, you have a trade where you're looking to get long here. You have your stop down here. Maybe you're looking to target up here or this supply zone up at 123, and you end up getting stopped out, right? Why did that happen? So the concept that I want you guys to understand is market structure, right? So why did this demand zone fail? And the reason for that is that it never took out this supply, right? So I want you guys to really look at this, right? We have lower low, lower high. We create a lower low, we create a lower high, and then we have a lower low. This low, right, this demand, all the buyers here are not able to take out this high. They're not able to take out the sellers at this supply zone, right? We have this rally, base, drop supply zone. The buyers are not able to take out supply, right? So sellers are still in control, right? Because if you remember, we're in a downtrend, right? So sellers are in control. So if we're in a downtrend, this demand is not able to take out this supply. Sellers are in control. You don't want to be buying this demand zone, right? Sure, it worked for a little bit, right? You can scalp it, take a few profits, but you're not going to get any high quality moves off of this, right? You want to make sure that demand is able to take out supply. Let me show you another example. Let's take a look at Apple. up over here on the daily chart, right? So we have price, let me just draw this out for you. Price comes up, price comes down, up, down, right? Making lower lows, lower highs, right? Lower low, lower high, lower low, just slightly, but lower high, and then we end up making a lower low, right? So this is the start of a downtrend, right? So price, even though this is a good demand zone, right? We drop, we base, we have a huge gap. It's a very strong move all the way up to 176 from 160. But price is not able to take out this supply, right? So sellers are still in control, right? If price can't take out this supply, this demand zone is not going to hold. And that's exactly what happened. It ended up going all the way down to 151, right? If price were to do something like this, or went above that supply and then come back down, we probably would have saw a bounce, right? So that's something that I use. That's market structure, right? Price couldn't break supply. Sellers are in control, so you don't want to be buying demand. Let me show you the best example I can show you on PTON, right? So what happens? This is supply, right? Price comes up, we rally, we base, then we drop. So we draw that supply zone here. We hit supply, and we end up breaking this demand, right? So you don't want to be buying this demand zone here because this demand was not able to take out this supply, right? Very simple concept. So price comes down, we take out this demand, and then price ends up coming up and takes out this supply zone, right? So now we have a shift in market structure. We have a shift in trend, right? Now demand and buyers are in control. This drop base rally demand zone was able to take out this high, able to take out this supply zone. So now we can start to look for buying and demand. And what happens? Price comes down to this demand zone, right? Or we could even draw the zone here. Price comes down, holds in the zone, and then ends up breaking the supply and moving higher, right? So once we got that shift in market structure, once demand was able to take out supply, buyers exceeded sellers, that's when you want to go and look to buy demand zones, right? Take a look at NQ on the 2-hour chart. You can see price started creeping up. We have a nice supply zone here, right? Really fast move, nice rally base drop zone, and we just went right through it. Now, why did that happen? The trend, right? Trend started to shift, so we're making higher highs, higher lows, and also this supply zone right here, this drop, was not able to take out this demand, right? It didn't even really reach this demand zone, unless you count it from here. If you look at a higher time frame, it would be right here. Yeah, we couldn't even really reach demand, right? Just barely. So the fact that price or supply couldn't even take out demand means you don't want to be shorting in supply, right? And since this demand, right, new demand formed here, was able to take out this supply and this high here, price came down into this demand and then ended up going higher, right? And then you don't want to be shorting at this supply as well because it wasn't able to take out this demand. So market structure is all about learning where's your highs, where are your lows, was your supply able to take out demand, and if not, was demand able to take out supply? And that's going to give you a better clue of when to get in and out of your zone. So I hope you guys enjoyed this video, and I will see you in the next one. All right, guys, what's going on? Hope you guys are having a good day. Welcome to the final video of the course. So this video is going to dive into the 2 ways to tell if a zone will fail. So let's go ahead and get right into it. So the 2 different ways to tell if a zone will fail are based off time and depth, okay? So the 2 pieces of information that you guys should remember is the longer price spends in a zone, the higher chance the zone will fail. And the deeper price goes into a zone, the higher chance the zone will fail as well. So let me show you some examples, and hopefully that will make more sense if it's not that clear to you at the moment. So let's take a look at SPY on the weekly chart. You can see SPY, we have a nice supply zone, right? We rally, we base, we drop, very fast drop. Nice supply zone drawn out on the weekly. If I go on the daily, you can see, really nice push up, solid, tight consolidation, very fast move down, very classic supply zone, okay? So this one, we're going to talk about time. So, right, the way supply and demand zones work is that you should see a pretty fast reaction from them, right? So that means, if you're trading a weekly or a daily supply zone, you'd want to see price hit that zone and then come out of it within a day, 2 days max, right? As you can see on SPY, what happens is price comes into this supply zone. We close inside of it on the daily. And we spend like 5 more days, right? 1, 2, 3, 4, 5, 6, 7 more days in the zone before it ends up actually breaking and not working, right? So how do we use this to our advantage, right? So if price comes into a zone and it's been there for a while, right? 3, 4 days, you can kind of tell that maybe this zone isn't going to work. And you can exit the position early at a very small loss or even break even, right? Depending on the setup, right? So this is something that you can use to manage your risk a little bit better and get out before you actually end up getting stopped out. So you can see SPY, we come up, we hold into demand, we never even come back out, into supply, we never even end up coming out. We just consolidate in supply and it ends up breaking higher, right? So understanding time is one way to tell that price is going to not work in a zone. Let's take a look at CAT, right? CAT, we have a daily demand zone right here. We drop, we base, we have a nice rally. Price comes down and we consolidate in the zone for 3 days, right? We don't bounce higher. We're kind of just consolidating. We're not really getting any bounce at all. There's not a lot of buyers showing up. So you can see that after that it ends up breaking. So if you get in on this day, on the 13th, you get in at the top of this demand zone at 205. 3 days go by, you're like, you know what, price is not bouncing as it should. We should have at least, went a little bit higher by now, seen some sort of reaction. You can exit the trade early for a small loss or maybe even profits before price ends up taking and you end up taking a big loss, right? So that's CAT. Let me take a look at CL futures, oil futures here, right? So the other way to tell is with depth, okay? What does that mean? That means how far price goes into the zone, right? So you can see on the oil futures, we have a 2-hour supply zone here, right? Price rallies, we base, we have a fast drop, end up going lower. Price ends up coming up, and you see this is the whole zone here, right? From 91.76 all the way to 92.66. Price, as we come in on the 2-hour time frame, we end up going pretty close to the top of that zone already, right? So what does that mean? That means that the sellers are not as strong as they should be, right? Typically, most of the time, you'll see supply and demand zones work where price will come up, just tip the, first portion of the zone, not too far in, and then go back out. Those are the best types of zones, right? The ones where they come in all the way down towards the end or all the way, up to the middle or past the middle, that's a pretty good indication that the zone may not work, right? Now, it's not 100% of the time. It still can work, right? You could have gotten short here, stop here, and, you would have been, in profit for a little bit. But understanding that, price, went pretty deep in, especially combined with time, it's been consolidating, not that well. You can kind of, get out early or move your stop to manage that risk a little bit better, right? So let's take a look at AMD. Last example I have. You can see on this demand zone here, 2-hour demand, price comes down, so we have a drop, we base, we have a rally. Price comes, we come all the way down to the bottom of the zone, right? So we come all the way down to the bottom. I mean, buyers are not that strong, right? We should have held up, near the top, near 87. We broke 87, came all the way down to the bottom. This ends up becoming more of a support resistance play more than a supply demand play. I focus on trading supply demand, not support and resistance, because support and resistance tends to fail more. So when you see price come all the way down to the bottom, it shows that this demand is not that valid, not that high quality. Although we did get a good bounce from it, we ended up breaking it in the future after that little bounce, right? So if you're trading this type of style and price, let's say this is your trade plan, and price hasn't hit your target, comes all the way down to the bottom, end up coming back, you're thinking, I don't know, you could stop out early, right? It's good to manage your risk, and you don't want to take losses that aren't necessary. So if you see something like this where A, it spends a lot of time in the zone, or B, it comes pretty deep into the zone, that may be a decent indication that you just want to monitor the trade a little bit better, maybe up your stops to break even, or give yourself a time frame of when you want to get out of the position to manage that risk. So all in all, if we go back, the two things to remember: time and depth. So the longer price spends in a zone, the higher chance the zone will fail, and the deeper price goes into a zone, the higher chance the zone will fail. So with that being said, guys, I hope you enjoyed this video and this course. If you took something away from this course, guys, please tweet at me. I love seeing the work I do, and it really makes a difference. So it would mean a lot to me if you could just let me know if this course helped you at all. And also, guys, remember to check your emails because I got some surprises for you. I'm not going to spam you or anything like that, but I got a lot of valuable info in those emails coming your way. So with that being said, guys, thank you so much for watching, and I hope you all enjoyed this course. All right, guys, welcome to this course. You're going to become a master at market structure by the end of it, okay? Now, this first video is going to be more of an intro. We're going to go over some things that are really basic, really concepts, get into some more advanced stuff later in the series. But you got to get the basics down if you want to understand the rest of that stuff. Now, before we do that, I do want to let you guys know that trend in itself and market structure in general is pretty much the basis of my trading. Now, of course, I look at a few other things. I look at supply, demand, I look at volume, I look at other confirmations that we have. But the basis of my trading is really about understanding market structure. If you can understand who is in control, bears or bulls, and you can do that with market structure, you can end up making a lot of money. So let's dive into the first topic and show you guys a little bit more about what I'm talking about. By the end of this series, you guys are going to become master. You're also going to have a strategy that I'm going to show you in the last video, specifically on how to scalp with trend and nothing else. Simply using trend. It's a scalping strategy I use. Works extremely well. So let's start with identifying the real trend. Now, as you guys probably know, trend is based off the fact of price and only price, okay? And what that simply means is higher highs and higher lows, right? Price in its general form is it comes with low points and high points. It's always going up and down, right? And so if price is making a low and then a high, then a low and a high, a low and a high, we continuously see the new lows taking out new highs. When I say take out, I mean price just moves above that new high, makes a new low, we take out that high again. And this pattern of higher highs, higher low, higher highs, higher lows is in an uptrend, okay? It's very, very easy to tell this is an uptrend. I know, very basic stuff. Stick with me, okay? It's going to get a lot more advanced than this. Same thing with the downtrend. Price making lower lows and lower highs, lower lows, lower highs, etc. This is in a downtrend. Now, the thing with market structure that a lot of people get mixed up is that, not even mixed up, it's just the fact that stocks, S&P 500, markets, they don't always go in trends like this that are this easy to spot, okay? Sometimes markets will do things like this. You can see the S&P 500 will go down, up, down, a high, will make the same high, consolidate, another high, another low, and then go fast like this. When you start to look at this, like, yeah, it's a little bit easier to see it's on an uptrend, but this area here gets a little complicated. See a high, a lower low, higher high, and then an equal low, some consolidation, another low that's equal to here, and it gets a little bit confusing. Okay, and by the end of the series, you guys are going to know exactly how all this works, and you're going to know pretty much how to look at this and say, okay, I still know who's in control. I know that I shouldn't be getting short here because price is going to move higher. And that involves a few other different factors we're going to be looking at. But simply for this video and what you need to know, like I said, it's kind of like an intro, setting you up for the rest of the videos. But the basis of trading and understanding this is based off higher highs, higher lows, higher highs, higher lows. Lower lows, lower highs, lower lows, lower highs. That's going to be a downtrend. This is your uptrend. Complete basic stuff, okay? In the next video, I'm about to show you exactly how to spot a fake trend, okay? Because sometimes price will do something like this. We'll be making higher highs, we'll break some of these lows, and we'll just keep going back up. And that's going to be extremely confusing if you start thinking we're in a downtrend, right over here, but then price ends up going up. So stick for the next video. I'm going to show you exactly what that works. And the rest of the series, you're going to become a master at market structure, understanding trend, and you can use this across all markets. So I'll see you guys in the next video. All right, so this video is going to go over how to spot a fake trend, okay? As we both know, this market likes to fake a lot of people out all the time, okay? That's just how the market moves, and that's how it's designed to trap retail traders so they get stopped out at the exact bottoms and things like that. So there's a two-part series for this one. It's about spotting a fake trend. There's two ways to do it. The first one I'm going to show you right now. So let's get into it. Now, when it comes to a fake trend, obviously we understand a real trend, okay? For example, if this is our trend, we're in an uptrend. Now, we first need to understand what is a shift in trend before we get to that, okay? And a shift in structure per se, right? If we wanted to see price go from an uptrend to a downtrend, what would we want to see, right? We would want to see price take out a low and then start making lower lows and lower highs, right? So you want to see price come back down and then fail to make a new high up here, then make another low, okay? And at this point, now we're making lower lows, making lower highs, and we can continue this process, okay? So the first sign that we get that price is going to shift trend from an uptrend to a downtrend in this example is when we get a break of that low, okay? In an uptrend, highs should hold. In an uptrend, lows should hold. In a downtrend, highs should hold, okay? And so we know if price is continually holding the previous low that we have and it cannot get below it, we're in an uptrend. And so that first sign that price is now going to shift into a downtrend is when that low breaks. And this is where the fake trend comes into play. This is extremely dangerous to immediately think when price breaks that low that we are now in a downtrend. Okay, this is the fake. This happens all of the time. All of the time. Okay, you'll see price in an uptrend just like this, blah, blah, blah. You'll see price make a new low. Everybody's like, oh my God, we broke this low. We're starting to see a downtrend. Price pops up. They go short here, expecting to move lower, and then it goes right back up. And you're thinking, what just happened? You know, I thought we were shifting trend. I thought we're starting to see a downtrend. Why is that happening? And so I'm going to explain that in this video right now. The first reason for that, okay? Now, the first reason is actually something you may not expect. You have to use one little tool to pretty much on every platform, every broker, the Fibonacci tool. Now, I'm not going to go out here and show you, hey, listen, you got to look at the 0.236, the 7 point. No, you don't need any of this, okay? The only level that's important is a 50%. You're thinking, Jordan, is this like some number you pulled out of thin air? Like, why 50%? Where did you get this from? 50% is not something I came up with. 50% is something that is known in the institutional markets, simply because if you think about it logically, right? If I am even for products, even for whatever it is, what is 50% known as? 50% is known as the fair price or the middle price, which means if I'm a buyer, anything that's below 50% is going to be a good deal, right? In terms of price or whatever you want to call it, right? If we're in a market and I'm looking to buy something and I can get it at a 50% or not even 50%, if I can get it lower than the middle price or the fair price or the average price, whatever you want to call it, that is a good deal, which means anyone who's buying below 50% are going to be institutions or the market makers, okay? The hedge funds, the ones with money, right? Trust me, they're not going to be buying while the price is high. They're only going to be buying below 50%. They're only going to be selling above 50%. That's extremely important. So let me show you an example of how this works and what this means. Simply means, in an uptrend, every low that goes below 50% is what we call a strong low. So let me grab this here. So we have a deep pullback, that's a strong low. Another deep pullback, strong low. Another deep pullback, strong low. These are all strong because price went lower, at least, or right to it, the 50% mark. Below it, below it, below it. And then you go ahead and you move it. This one goes up here, this one goes out in here, below 50%. And the trap that a lot of people get put in is that a lot of times, price will make a low that is just very shallow. That'll make a new high. We'll see something like this, right? You may pull out your little Fibonacci tool and you go, okay, we probably retraced like maybe 20%, I don't know. And we made another high. And this is when you got to ask yourself, are the institutions or the hedge funds, are they buying up here? No, they're not going to be buying up here. Trust me, if we are in a market that looks like this, okay, they buy low, they sell high. They're not going to be buying while the price is high, Okay, a small pullback is not enough for them to get in, which means you don't want to be getting in there as well. Now, could we have a situation where price just, has these small pullbacks and keeps going up and up and up, and you're like, Jordan, I'm missing the move? Yes, that can definitely happen. But if you want to have the best setups, the best probability of success, you only want to be buying pullbacks that are lower than 50%. So, what is the fake? What does that mean? How does this work? Well, a lot of times we'll get something like this. We'll get a deep pullback, we'll get a small pullback, and then price will end up breaking that low. And we're going back up. Price breaks this low here, then everyone at this moment in time when price is down here starts screaming, oh my god, we're in a downtrend. Okay, we have a sharp move lower, we break that low, and we start to say we're in a downtrend. This is the trap. This is what we call a bear trap. Right there. Okay? A bunch of people see this short or see this break and they're like, hey, I want to get short. They wait for a pullback, expecting another move lower, and price goes higher. This is a very common pattern that you see all the time. And you'll notice a lot of times this pullback will go at least 50% from this retracement here. And then end up ripping right up. Okay? When you start to add in supply demand, there's a lot of things that get involved with this. You'll start to notice, hey, there's a really good supply zone here. Why is it not holding? Because of market structure. We are still in an overall uptrend. Okay? This is not a real low. This is not a real low. Okay? Take a screenshot of this. Do whatever you have to do. This is the bear trap. Okay? Do not get trapped. This is the fake trend. So let me show you two more examples so you can actually understand this and see this in the chart. Now, Amazon, you can see, you wouldn't be able to tell until recently, but we're starting to see forms of an uptrend here. Okay, we've been in a downtrend since 2022, making lower lows, lower highs. Let's just say we know at this point that we're in an uptrend. So, what does price do? Price moves up, we have a pullback, we move back up. Maybe think, Jordan, if we make out, our high points are our low points. We have a high, we have a low, we have another high. The price goes up, and we end up breaking this low. And you say, Jordan, we broke that low. That's the sign that, hey, we're starting to see a downtrend, right? We got that break. We should see price move over. Let's get a pullback up to supply for a move back down to $80. We just end up going right back above it. The reason is, did we pull back 50% from this low to this high? We did not. Okay? Institutions are not going to be buying in this area. Okay? They were buying down here. When price goes up and we have a small pullback, they're not buying up there. So then we see that breaks. Price breaks this low. And then we can, once the new high establishes, we can move our retracement up. And now, over here, now we're in a good deal. Right? Back here, we only knew that price went from this low to this high. This would not be a good deal to buy in. Okay? And we can talk about time frame of like, oh, well, in the higher time frame, like that's a really good deal. But that's for another video that you'll see later coming up. But for now, just in the smaller time frame or in the daily time frame, right? Once we get that 50% pullback, now we know, okay, this is going to be a good low. Price moves higher. You can repeat the pattern. Let me show you an example on Walmart. Same thing. Okay? Oops. Price starts low, high, low, high. Pull back way more than 50%, right? Almost even, which is really good. Come back, 50%, back higher. Another one, 50%. And yeah, typically you can just eyeball it. It's not always perfect. You can always just drag it out, but you can see we're constantly making lower lows and lower highs. Sorry, higher lows and higher highs. So you can see that's our low. Then we end up making a new high. That's our low. We pull it back, we make a new high. That's our low. We pull back, so we break this high here. And then we get a pullback here, then we move up. And this pullback right here, you may be saying, Jordan, right here, we end up breaking that low, right? Wouldn't that be a start to see a downtrend, right? That's the same pattern you're talking about, just like this. Right? We break this low, that's a shift in trend. Shouldn't we start to get bearish? No. Why? Because this is not a strong low. This is not retrace 50% from this low here, which means it's not in a good deal in this scenario, which means institutions are not buying right here. Okay? Maybe they were in terms of earnings, right? Maybe they had some insider info, but typically they're going to be waiting for that 50% retrace. And you can see exactly how the market likes to work. Prices start to go in an uptrend. They have good earnings. Now a bunch of retail. Everyone wants to buy, buy, buy. And then what do? They take it lower. Where do they take it lower to? Right below this key support line, stopping everybody out. And then they move it up higher. You guys see where I'm getting at? And if we pull the retracement from the low to the high, now we end up getting that good deal. Now price, now that we've established a new range, price has now entered a good deal. I mean, you could have entered it down here, but down here, okay? Really, really simple stuff. By simply using the 50% retracement tool, you're going to know exactly where the real trend is, okay? And you're going to understand that this is all a fake. So when you try and buy this pullback here down to demand, you put your stop loss right here, right under that low, and then you get stopped out, with the 50% rule, that shouldn't be happening, okay? And the reason why this works so well is because people put their stop losses right below new lows of an uptrend, which is a logical stop, right? If price is an uptrend, price should not be going lower than the previous low. So it makes sense to have your stop loss right below it. So when we see something like this and we understand that institutions are not going to be buying in this area, you can see exactly how it plays out. You get earnings, Amazon goes up, a bunch of retail buys. We even get a huge pullback, a bunch of retail, they keep buying, and then boom, they shake everyone out here. Now everyone starts getting bearish. It's a bear trap. Institutions get long, they bring it up to new highs, and they sell up here. The same thing happens every single day. It's the same pattern, okay? So hopefully this video made sense, okay? The next video, how to spot a fake trend, part 2. It's going to be more over another way to spot a fake trend, because trust me, there's a lot of ways that they'll fake you out. This was just one of them. So hope you guys enjoyed this one. Study it, take some notes, and I'll see you guys in the next video. All right, welcome to video 3 of Mastering Market Structure. So we're going to talk about how to spot a fake trend, part 2. So I showed you in the last video about the 50% pullbacks, okay? Now this one is a little bit different, but it is definitely something you need to pay attention to, because it happens a lot, especially in the futures market as well, but also in stocks, in every market. Happens all the time. It's a huge fake out. So as we mentioned before, uptrend, higher highs, higher lows, things like that. When do we see that shift in trend? When price breaks that low, we need to think about the 50% rule. Now the one thing we haven't talked about is, essentially talking about fake traps again, right? And so I'm going to show you exactly what that means. So let's take a look at NQ. Now NQ at this point in time, very clearly in a downtrend at this pattern, okay? We can see price goes low, high, low, high, low, higher, high, question mark, and then low, and then high, and then continues going on. And this is what we're going to talk about right here, where we start to see Jordan, price ended up breaking that high. In a downtrend, highs should hold. Why was price able to take out that high? Shouldn't that mean price is going to be in an uptrend now? Shouldn't we be buying this pullback for a move higher? Jordan, what are you talking about? I understand. We're going to break that down for you right now. So we have all the properties of a downtrend, right? We have a high, we make a new low, okay? We have a high, we make a new low. So this is our strong high. So the first thing we do is when price is coming up to this, we say, okay, the price pulled back more than 50% from this high to this low? Yes. I mean, we went basically all the way past it. So we know that this is our high we want to play, and the price ended up breaking it right here. Now, why did price break this high but then not make a lower or higher low and then move up? Why did we go back lower? And the reason is called something that you've probably heard of, which is called a stop hunt, okay? They're very common all the time. It's actually one of the strategies I use in my 3-phase system. But a stop hunt is something that you need to pay attention to, okay? I have an entire strategy around it. But we're just going to go over what it is and how to spot it with market structure. Stop hunts are basically where price takes out a low or a high. We just wick right above it or below it to get some liquidity and then end up going back in the original trend, okay? Happens a lot, okay, especially in the futures market. You can see there's pretty much another one right here. Price just barely takes out a lower high, just by a few points, a few ticks, we end up ripping right alongside the other way. So first thing is, how do we know if this is a stop hunt versus a real trend, right? How do we know, how do we know this move right here isn't a stop hunt of these lows? And then we can, look for it to continue moving higher. Well, the properties of stop hunt are pretty simple, right? The only thing you have to recognize is this not a stop hunt or is it? And really, you can tell simply by looking at the candle close, okay? There's a few other ways to look at it that are a little bit more specific, a little bit more in detail. But for the basics, all you need to know is that if price just wicks above or below a high and then immediately reverses and starts going the other way, just like right here, it's a stop hunt. Okay, it's on a 30-minute chart. You can see on an hourly chart. You can see on the 2-hour chart. Now, what if, let's say on this 30-minute chart here, price were to close above this high and then continue moving a little bit higher? That, in my opinion, now would be not a stop hunt. Why? Because price was able to close above it. Okay? The thing with stop hunts is that they happen extremely fast. So price, at least in a higher time frame sense, shouldn't close above that high if it's a stop hunt. Okay? You can see down here, price made a low, we broke that low, we had a few candles below it, we easily closed below it, right? We had a few pieces of consolidation below it, right? It wasn't just a wick right through an immediate reversal. Okay? You can see we actually broke this low again when we came right back through it a second time. Okay? So when you have price that breaks it more than once, when you have price that closes above or below a certain low or high, that's how you know that it's a real move in its favor and it's not a stop hunt. And if you know it's not a stop hunt, then you can understand that, hey, we probably have a shift in trend going on. But when price just barely comes up, wicks right above it, and then immediately reverses, that's a stop hunt, okay? That does not mean that the trend is changing. It's an extremely important concept you need to understand, okay? If price does not stop hunt, shift is probably going to trend. There's probably going to be a shift in trend, excuse me. If price does stop hunt, right, we should wick above and immediately go back below, then it means that the original trend is still in favor. It was just a fake out, okay? It was just market makers, institutions, whatever it is, moving price above here. There's probably a lot of stop losses right above here, stopping everyone out, and then bringing it back in its original direction. Happens time and time again. Let me show you another example on ES. Let me zoom out a little bit of a higher time frame perspective here. This is that example I was showing you in the middle, right? Where it basically was saying, hey, price is going to look crazy. How do we know what the trend is? It's very consolidative. We're in a very up and down state. How do we know what's going on? Well, let's say this is our strong low here, okay? I don't think it is because we didn't retrace 50% from this low. It's not. But let's just assume it was, okay? Sorry, talking about this one here. I think this one did, actually. From that low there. Yes. So let's say this is our strong low here, right? So if we're in an uptrend, we have a low, a high, a low. The price makes a new high, okay? Now at this point, I'm just going to clear this up so it's a little bit easier to see, right? This is what our trend looks like. Just make it a little bit higher. At this point, we're saying to ourselves, Jordan, we're in an uptrend, okay? We want to be buying pullbacks in an uptrend. So if price pulls back, I want to buy for a move higher. I want to put my stop below this low because in an uptrend, lows shouldn't break. And I want to target the highs up here. You want to be setting up a trade like this, okay? Now, in this case, you would have gotten stopped out, right? Let's say you bought the pullback right here, down here. Then you put your stop right below that low. You would have gotten stopped out. You got it wicked right below. And then we end up going and making new highs all the way after that. So how do we avoid this? How do we know that, Jordan, this low is actually not a strong low? This is a low that we don't want to put our stop under. How do we know that? Well, a low only becomes strong. For example, this one only becomes strong when we break the previous high that was formed, okay? But we don't just not stop hunt it. That didn't make sense. What I mean by that is that price cannot stop hunt this high. If price stop hunts this high and we immediately reverse, this low is no longer valid. This is not a low that you want to be putting your stop under, okay? So if we look here, originally this was our low that we were looking at. So we could have bought the 50% pullback here, right? We could have got in here, put our stop below this low, target the highs, and we see the uptrend form, and then price ends up making a new high. But then what do we see here? For the daily time frame, price stop hunts that high. We wick right above it, and then we immediately dump. Right? Very fast. Very, very fast. Same thing with the 2 hour. We wick right above it, we immediately dump. This is a stop hunt. This was a trap. This trapped a lot of bulls. When you see that happen, you have to ask yourself, okay, if this low, we were able to take price above this high, but we weren't able to really, have a real break of this high. It was just a stop hunt. So if it's only a stop hunt, then this low is not real, right? These buyers, this low, there's nothing controlling that low because we didn't have enough strength to take it above this high. When I mean take it above, I mean really get above it and break it through, okay? We were only able to stop hunt it. When you only are able to stop hunt it, this low becomes invalidated, which means you don't want to put your stop below that low, okay? I know that's a little complicated, but let me go ahead and just show you here. Even if we have the 50% retrace, we just barely stop hunt above that high, barely get above it, we immediately dump. You don't want to be buying this pullback here because we can easily take out this low and then continue moving higher. Simply because we stop hunted this high. We didn't break it. We didn't take it out. We didn't go all the way above it like here. We just quickly stop hunted it. And so the low that stop hunts the high, I'm going to say this one more time. Write this down if you need to. The low that stop hunts the high is not a real low. It's not a strong low. It's not a low that you want to put your stop under. Okay, because people who shorted here are going to be targeting right down there. And then they're going to be buying for another move higher. This pattern happens a lot as well. It's a huge trap. It happened all the time. Right down here, price took out these lows. Right, remember that 50% rule? This right here trapped all the buyers, right? It trapped a bunch of shorts. They squeezed it up, trapped a bunch of longs who trying to buy the breakout, and they took it back over and stopped everyone out who's long buying this pullback here. Okay? It's extremely important that you're able to understand if price stop hunts a high or if it actually takes it out. If you can understand that difference, you can really understand who's in control and how to move with that. So I hope you guys enjoyed this video. Very, very important video. Make sure you study it. Might have to rewatch it. The best thing to do is look back on the charts, understand, just study for yourself, see what's going on. But with that being said, guys, I'll see you in the next video. All right, guys, so this video is going to be a good one. All right, it's about time frame analysis with trend. I get asked all the time, Jordan, what time frames do you look at? How do I know which time frames to look at? I'm going to break that down and apply it to trend and market structure in this video. So first thing, let's go ahead and just look at this, okay? Here's a concept that you guys need to understand, okay? We all need to understand this. You could have multiple trends in multiple different time frames. It can get very complicated very fast. What I mean by that is, let me show you this. We could be in an overall uptrend, okay? Let me redraw that actually. We can be an overall uptrend, higher time frame uptrend. We can be downtrending in the uptrend. And in this downtrend, we could also be uptrending here. Just like this. See what I mean? We have three trends going on. We have the biggest trend, or the biggest time frame, we're in an uptrend, right? High, low, high, low, high. In the medium time frame, we're in a downtrend here, right? Low, 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 low. And in the even smaller time frame, for example here, we're in an uptrend again. Higher highs, higher lows, higher highs, higher lows. This is where things get really complicated, okay? Because you can look at trend as a multi-time frame analysis. You always need to be looking at a multi-time frame analysis because you're going to be getting very confused, like, hey, we're in a downtrend. You know, you could be saying that right down here. And then you look to get short, and then we just get squeezed higher, okay? So understanding trend with time frame is extremely important. Let me look at ES right here. Beautiful, beautiful example. Price is in a very clear uptrend, higher highs, higher lows, etc. And then right here, if we were to zoom in, we'd see prices making lower lows and lower highs, just like this. Right? I could zoom in right here. You could say, Jordan, we're making lower lows, lower highs. And then at this point, price goes up, and you're like, hey, we're in a downtrend. We're making lower lows, lower highs. Jordan, let me get short. Let me short right here, put a stop above this high. You know, aiming for new lows all the way down here. And then you end up getting stopped out. You're like, what the heck just happened? We're in a downtrend. The key thing you have to remember, is you need to understand what time frame you want to be trading, what you're looking at. Okay? Extremely, extremely crucial. Now, what time frames you're going to be looking at and which one you're going to be trading is all dependent on you and your strategy. If you're a scalper, you're looking at the 1 minute chart, right? You want to get in and out in a few minutes, then the overall trend in the weekly time frame isn't going to matter that much to you. But if you're a swing trader, maybe you're getting in and out, in a few weeks or whatever, you're looking at the hourly chart, and we're in a situation like this where you want to get short right here for a 2 to 3 day swing for a move down lower. If you're not looking at the higher time frame, understanding that we are in an uptrend, you're going to be shorting in the wrong time. You're going to be shorting in the wrong time, okay? So you need to always look at your time frames, understand what's going on in the larger context, okay? Because we can be in a situation, really pay attention here. We can be in a situation where price is pulling back like this. We have a 50% pullback. Everything's looking good, right? And let's say you decide to get short right here on this pullback, expecting another move lower. Because you're looking at this time frame and you're saying, Jordan, right? We're in a downtrend right here. I want to look to get short for another move lower. And we end up just ripping right above. Because if you're not looking at the higher time frame trend, you start to say, okay, I'm going to get short, and we just end up going higher. Now, the best thing to do, this is extremely important, is you typically want to look and take lower time frame trades with the higher time frame trend. Okay? So if we are in an overall uptrend, you typically want to stay away from shorting in a downtrend. Now, you may be saying, Jordan, well, this is like a daily time frame, and we're looking at a 5-15 minute here. Are you sure, it's okay. I can probably just take a 10 to 15 minute scalp, whatever, and you can trade it that way. Of course you can do that. I'm not telling you what you can do. Me personally, I want to have the best edge in my favor. And so the best edge is going to be buying pullbacks of this trend here. Make this blue, right? When price is in an uptrend in a higher time frame, and you're buying the pullbacks here. Let me redraw it. Actually, this will be easier to see. I didn't draw this the best. Let me draw it like this. Just like this, right? And we go lower. Because you got to understand, price does this, right? Price is not making straight lines like I'm drawing them right now, okay? Price goes up and down. We have, uptrends inside of a higher time frame uptrend. We have downtrends inside of a higher time frame uptrend as well. And so if you're buying the pullbacks on the legs of the uptrends, if you're buying pullbacks in this area or buying pullbacks in this part of the move or this part of the move, you're giving yourself a much higher probability of success simply by following lower time frame trend with higher time frame trend. When you combine trend, you give yourself an automatic edge in the marketplace. You need to understand that. You're literally just giving yourself an automatic edge. And when you're going against the trend in a time frame perspective, right? Because trust me, there's going to be opportunities where price will be in an uptrend, and you'll see a really solid short setup, like right here. But if you understand we're in a higher time frame uptrend and you want to have the best edge possibility and the best edge possible and the best chance for success, you want to go with the higher time frame trend. Okay? So I know this was a short video, but I wanted to quickly touch on this topic because it is extremely important. And doing a simple tweak like this, just focusing on the higher time frame trend and trading the smaller time frames in line of the higher time frame trend, that itself is going to give you a massive edge in your trading. So I hope you guys enjoyed this one. I'll see you all in the next video. All right, so last video of the course, unless I end up adding to it or making it more. But yeah, we're going to go over scalping with the trend. Now, this is a strategy. This is actually really cool. This is something that I do. Doesn't use any indicators. Don't even need volume. And it's just a 1 minute chart. It's a scalping strategy you can do solely using market structure. That is it. Okay? Like literally nothing else. No indicators, no supply demand, no volume, no nothing. Okay? And it's basically just playing the trend. Okay, it's identifying a shift in trend and then going with that move. So, how do we do this? Well, you look at the 1 minute chart, we'll pull up a stock like Meta. I'll show you another example. But you want to just wait. The first like 15, 30 minutes, depending on what happens, you just want to wait. You want to wait for price to identify a certain trend. So you can see with Meta in the beginning, you can see we go down, we go up, we make a low, we go down. We're pretty clearly in a downtrend, right? We go down, high, low. We've made a move lower. All right, we're in a downtrend at this point. And so what do we want to see? We want to see price end up breaking this high or breaking this high for us to say we're now going to be in an uptrend. And so what does price do? Price ends up breaking that high. So when price makes a low and we make a new high, we end up shifting trend. We now understand that buyers are in control, right? This is a shift in market structure. This is a shift when price moves all the way up here that we now know price is now making higher highs and higher lows. We are now in a confirmed uptrend. Okay? And if we know this, we say, okay, well, let's go ahead and wait. Let's wait for a pullback and simply just play the trend. That's it. When price starts in a downtrend and we end up breaking that trend, you play the uptrend. Okay, you play this pullback here, or you play this pullback here, or you play this pullback here. That's all it is. So when price ends up going higher, we wait for that pullback. Now again, what's that key thing that we talk about? If we want to have a good risk reward, we're the 50% rule, right? We don't want to be buying on these shallow pullbacks here. Because again, that's not where institutions buy. And if our logical stop is going to be at the last low, and we want to target the high, it's not going to be a good risk reward. Okay, if we're getting in here, stops at the low and it targets the last high, it's a 0.5 risk reward. Right? We want to have a good risk reward as well. So we wait, we ask ourselves, okay, price pullback 50% here, so this is our strong low. We didn't do it there, blah, blah, blah. And we end up doing it here. Okay? So when price ends up finally making this high all the way up here, from this low all the way up to this high, we can now get our 50% pullback right here. Again, same thing. We take out this low and this low here, right? We trap a bunch of the bears. They break this low. They start to think, hey, we're starting to be in a downtrend. That's actually where you want to buy. And so you could easily set up a trade where you get long right at the 50% mark, put your stop at the low, or that low, where our 50% mark was drawn. We target the highs. It's a nice one-on-one risk-reward trade. Now, one-on-one risk-reward trades aren't ideal. Okay, it's not perfect, right? Obviously, you want to shoot for more. This is just a basic rundown of the strategy, right? Ideally, you want to look for other confirmations, right? I look at volume, I look at supply demand, I look at a lot of things, okay? I keep my trading simple, but I do look at a lot of other things to give myself a much better edge so I can hit 2R, 3R, 4R trades. But if we're keeping it simple, simply looking at market structure, this is something you can do. And what does price do? Pull back all the way down lower. If you wanted to, you could wait for the 50% retracement. Oops. From this high to this low, get in right there, put your stop at the low, target the high, and there you go. You can obviously hold some runners, get a nice 2R trade in there. But simply looking at market structure, understanding who's in control, you can have a strategy. Now, let me show you one more on SPX. Okay. If I can find it, it's over here. All right, this is another example. Simply looking at market structure, you can understand who's in control and what's going to happen. Okay, so what does price do? This is extremely important. Really want you guys to dial in and listen here. Take some notes. Price starts in a downtrend. We have a low, we have a high, we have a low. Okay, we have a downtrend. Now, when price breaks that high, we start to see confirmation of an uptrend, right? So price breaks that high. Now we'd see price is in an uptrend. So at this point in time, this is very crucial to understand, okay? At this point in time, when price is all the way up here, or technically right above here, we know that this low should hold. Why? Okay? Well, if we know that price was in a downtrend, and now we're in an uptrend, just like this. This is the exact same layout as price right here, right? I can just draw it in like this. we now know that this low should hold because in an uptrend, lows hold. So price is not going to go below this low. That's the thesis that we're trading based off, right? You always want to trade based off a thesis, one that makes sense, a logical one, right? And so if we know that this low should hold, then we know, okay, let's wait a second. If we know this low is going to hold, then we want to put our stop right below that low. That's a logical place to put a stop. So if we know our stop's going to be at this low, we also know, where does price go in an uptrend? It goes up to that recent high, right? It goes back up to that high. It goes towards liquidity, which in itself is a whole nother topic. But for this purpose, we know that price wants to go up to this high right here, okay? So when price goes up, we make that high. Let's say we're in this situation right now. Let's say price is right here, and we're able to identify all of this, okay? Price is sitting right here. We understand price is not going to go below this low. It's not guaranteed, right? But that's our strategy. That's our thesis. And that price wants to go back up to its high. Price wants to make another high if it's in an uptrend. So then all you need to do is simply identify what risk reward do you want. And you can just pick wherever you want, and then you can enter. Right? This is trading with logical entries and exits. Okay? Extremely important to understand, right? We're not just putting our stops in random places. We're not putting our targets in random places. If you understand market structure, you can understand and get a bias and understand, hey, at this point in time, the edge is in my favor. There's a probability, a good probability, that price is not going to go below this low. And if you know that, there's a million ways you can make money off that. You can do it through credit spreads. You can do it through just getting in here, putting your target up there, putting your stop below this low, right? You can wait for a pullback to a supply zone or a demand zone. You can use volume, right? There's a million ways you can craft it. Now, there's just specific ways that I craft it in my strategy. But that's for a whole, that's a whole thing on itself. But for this, simple purposes, right, that's what we know. We know where a logical stop would be. We know where a logical target would be. Then it's up to you to identify, do I want to get in right at the 50%, go for a 1-to-1 risk reward? Do I want to wait for a demand zone all the way down here? Maybe I won't get it. Maybe I will. That's a nice 3.7 hour trade. Maybe you're just, you want to get in all the way up here. You don't care about your risk reward. You want to do that. That's not ideal, right? It's not typically how we want to trade. But at the end of the day, it's up to you. And then you can spend the rest of the day knowing and understanding that buyers are in control and that price shouldn't go below this low. Now, again, you can look at higher time frame context. You can look at, there's a million things that are going to affect price. It's not going to be 100%. But if you have an idea of the market structure on a specific time frame, and you can identify where's the logical stop, where's the logical entry, and which lows and which highs should hold and shouldn't hold, you can have a money-making strategy based off that. And that is what I use in all of my trading, and it makes sense. And I hope that it makes sense for you as well, because it should. It's logic. So that is basically going to be it. Hope you guys enjoyed this series. Hope you guys enjoyed this video as well. Like I said, market structure is just one piece of the puzzle. Okay, I look at a lot of different things. It is the backbone of my trading, along with supply, demand, and a few other things. But it is extremely important that you guys can understand this and use it in your trading as well. So I hope this did, make sense to you. Hope you guys learned from it. If you did, tweet at me, right? Give me a shout. Twitter, you leave a YouTube comment. I don't really answer my Discord DMs if you're finding me in Discord. But give me a shout on Twitter. Send me a DM if you want to learn more about exactly how I trade and my exact system and what I do for my exact criteria for entries and exits and how I look at higher time frames and all that stuff. Send me a DM, okay? We'll get you set up on a call and get you inside my one-on-one mentorship. But I hope you guys did enjoy this. All right, let me know how it was. I can definitely make more, whether it's market structure, whether it's a brand new topic. I'm always down for that. So let me know. Hope you guys enjoyed this series. And yeah, I'll see you guys in the next course, whatever it is.